So good morning, everybody. Thank you for joining us today for today's Growth Basics for Business. Today's topic is what they didn't tell you about starting a business. It's sort of a personal finance guide for entrepreneurs. Before we get into the presentation, before I introduce our speaker, Allison Bishop, I want to talk about our sponsor for today. Eaton Peabody law firm is our exclusive sponsor. Since 2018, they've been the sponsor of Growth Basics for Business. Eaton Peabody is a Maine-based legal and consulting firm serving New England and Atlantic Canada with offices from Augusta, Bangor, Brunswick, and Ellsworth, and here in Portland. They offer sophisticated legal and consulting expertise that emphasizes the responsive client services to companies, nonprofits, municipalities, and individuals. Now, about our speaker today, Allison Bishop, CPA and financial coach, started her business in 2015 after recognizing a need for totally unbiased financial advice for regular people like you and me. There's a deficiency in basic financial literacy, as well as a lack of confidence around people's ability to manage their money. She works with individuals to identify and prioritize their financial goals and to come up with a workable plan to give direction to their money. She also works with employers who are concerned about the financial health of their employees, helping them to come up with a financial wellness program and provide individual financial coaching within that program for anyone interested. Allison comes to us today by way of ACE, the Association of Consulting Experts. ACE is a nonprofit, member-based organization comprised of professionals, retirees, and lifelong consultants who bring decades of experience. This year, ACE will be providing the Chamber content in the form of monthly blog posts, as well as periodic speaker presentations like today. And I also want to mention that as of last night, as I was signing off for the day, I looked and noticed that Allison is the newest member of the Chamber. So welcome, Allison. A couple of housekeeping things. The presentation will take about 40 minutes or so, and there will be time at the end for some Q&A. If you do have questions, go ahead and type them in the chat, or if it's something that's really pressing to whatever Allison might be speaking about, you can go ahead and raise your hand, and we'll unmute you and have your question asked right there on the spot. Please mute your microphone if you're not speaking. Keep in mind the webinar will be recorded, and an email will be sent to you after the event with a link to the recording, as well as the slide deck that Allison is covering today. And without any further ado, Allison, take it away.
Thank you. So as Tommy said, my name's Allison Bishop. I'm a financial coach in Portland, which means that I talk to people about their money and really how to give direction to their personal finances. So as you can imagine, I see a lot of self-employed folks in my office because being self-employed brings opportunities for enhancing our personal finances, but also brings a lot of challenges. And also, I'm a small business owner myself. So I started my business, like Tommy said, 5 years ago. I'm a sole proprietor. I don't have any employees. I'm currently not incorporated, but I am considering incorporation. So I deal with the things that we're going to talk about today on a regular basis with my own business as well. So I was really excited to get this opportunity to talk about this intersection of business, of small business and personal finance, because it's something I talk about a lot one-on-one, and I don't get a chance to talk about it to groups a lot. And I'm just excited to reach people maybe whose paths I wouldn't have crossed with mine anyway. Okay, so I am going to share my screen. Okay, so let me start this. Okay. And I called it what they didn't tell you about starting a business, because I do feel like, there are places to get, mentorship and resources for starting a small business, but they don't always talk about how it affects your personal finances. And I think most of us started a small business to enhance our personal finances in some way, whether it's just to pay our basic living expenses or to pay off debt or to, save for retirement or college or something like that. And in general, we don't learn about financial literacy. We don't learn about it in school, mostly. And there's not really a lot of resources. You kind of have to be self-taught. Okay, so the first thing, when you are starting a business, one of the first things that you typically decide is, where does your money go? Whatever income you're making from your business. And so sometimes people just start with using their personal checking accounts and savings accounts and stuff, because they're just not, it hasn't occurred to them maybe to get a business bank account. So when you do mix your business and your personal funds, like in your personal checking account, it's called commingling. And so for most businesses, if you have a kid who's like got their own, I don't know, lawn mowing business, they're probably not going to have a business bank account. But for most businesses, it is wise to separate out your business and personal finances. And so what that means is a separate bank account, a credit card or a debit card that's associated with just that you use for business. And then I have on here accounting software, and it doesn't really need to be quite that formal. Like you don't actually need QuickBooks, depending on how complicated your business finances are. If it's relatively simple, you can keep track of it in Excel, or you can even pad and paper you can use. Just some way of good record keeping that will help you a lot at tax time, but also just to know, even if taxes were not in the picture, you need to know how profitable your business is. You need to know what your income looks like and what your expenses look like. And then so for the credit cards, I was going to say, my business has had a separate bank account and credit cards really from day one, and it just makes it so easy because I don't look through my personal bank account or my credit card statements looking for work expenses. I pay for all work expenses out of my work stuff, and I pay for my personal expenses out of my personal accounts, and it just makes it easy. So some businesses are actually required to separate out their business finances from their personal, and that's if you're incorporated. Because presumably one of the reasons you incorporated was to provide yourself with some protection against liability from your business creditors. They can't access your personal funds. But if you are mixing your business and your personal funds, that kind of takes down that protection, and it leaves your personal assets liable to your business creditors. So you're not allowed to do it if you're incorporated. Hopefully you know that. Okay, so managing unpredictable income is probably the number one thing I talk about with folks that come to me who are self-employed, because a lot of us, as you know, we have variable income. It fluctuates. Sometimes, depending on your industry, you might have a slow period, you might have slow months. And so it can be really difficult because our personal finances are usually more consistent. Obviously it can vary depending on what you're doing. And so one method I recommend is to kind of pay yourself a salary. So what you would do in this scenario is you calculate, first of all, you figure out how much does it cost you to live, and what does your business need to cover? Because of course, if you have a spouse who is bringing in income as well, that's going to affect how much your business needs to provide on a regular monthly basis. And then you just set up automatic transfers, like as if you're getting a paycheck. And of course, your business actually you could be getting a paycheck, but obviously this is for people who are not getting that. So setting up an automatic transfer. So let's say, just for easy math, that it costs you $4,000 a month to live. You could set up just, an automatic transfer from your business account, or if you are not using a business account, from your have all your money go into your savings and then transfer it over twice a month, $2,000, or weekly, $1,000 a week. But what I actually would prefer is also looking at when your personal expenses are paid out. So you might say, well, at the beginning of the month, I have rent, my student loan payment is due, and I have a credit card due. So my expenses are all bunched at the beginning of the month. And so in that case, you just match up your income and your expenses, and it takes your unpredictable income and it makes it way more predictable and smoother and easier to understand what is happening and easier to plan for. So this works if you are making enough money to cover your expenses in the long run. So the idea, of course, is that if you're having a good month, and let's say you earn $5,000 or $6,000 and you're only taking out $4,000, you are building up a cushion in that business account. And then if you have a slow month, that's okay. You can dip into that a little bit, so that the income you're taking out for personal use is consistent and easy to plan for. If you're not making enough money in the long run, this is not going to work for you. Or if let's say, we're in Maine, most of us. So let's say you're going into a slow season, it might be a difficult time of year to start that. But the benefit is, once you get it going, then you don't have to tighten your belts as much during that slow period. You have banked all the extra money that you've made during the more profitable periods. So prioritizing financial goals. This is the same graphic that I use no matter what group I talk to, but there's like a few variations that I'll mention. And so the whole concept of this is that people come to me and they might have 8 things that they need to figure out. So they've got, retirement's getting closer. Maybe they've got credit card debt. They've got a kid who's going to go to college in a few years. They've got a lot of stuff going on and they don't know how to prioritize and what to do first. So usually what we talk about is whatever gets you the best return on investment. And so what I mean by that is if you are paying off a credit card that has 22% interest, that's a 22% return on your investment. If you are saving money in a CD with a 1% interest rate, that's a 1% return on your investment. There might be as we go, you'll see there's other reasons. It's not strictly that, it's build up a solid financial base first. But overall, that's kind of the way that I look at it. So the first item on here actually may not apply to a lot of people on this call, at least through your self-employment, which is contribute up to the maximum match that your employer will provide. So of course, it could apply to you if you have a spouse who's employed at a salaried job and is eligible for a 401k or 403b, or you could have, even if you're self-employed, you also might be a salaried employee and have access to an employer retirement plan. So I didn't want to take it out because it might be relevant to some people here. But the reason that's first is because usually employer matches are either 50% match or 100% match. And so if you put in 3% of your salary and they match 3%, that is 100% return on your investment. And you can't get that anywhere else. It's free money. And even a 50% match is a 50% return on your investment. So it's a good deal. This is obviously not if you're struggling to pay the bills or put food on the table. This is like for people who have some disposable income and are trying to figure out where to prioritize it. The second thing on here is really for people who have credit card debt. It says consumer debt above 15% interest. And usually, almost always, what that means is credit card debt. So if you are in that position, that's really your next priority. But at the same time, you need to be saving. So I call it on here a savings cushion of $2,000 to $3,000. And the reason for that is because if you are throwing every dollar you have at your credit card debt because it's killing you and you need to get rid of it, if you don't have any cash, you're going to find yourself in a pickle at some point because you're going to have some expense that pops up that you're not going to have enough cash to pay for. So I always make that kind of an equal priority, at least to build up a small savings cushion while you are doing your best to pay off credit card debt. And I am going to skip a slide in a minute. So you'll see on the next one, it says start an emergency fund. And I want to explain what I mean by, because emergency fund and savings cushion kind of sound like the same thing. So I have a slide on what is the difference between these two things. So the emergency fund is really for like a life-changing emergency. And usually what that means is a major loss of income. So that may mean you have lost your job, your spouse one of you is disabled, your spouse has passed away, something has happened that has severely impacted your income. And this money needs to be available to do things like pay the rent, pay the mortgage, pay the electric bill, put food on the table. And so it needs to be kept sacred. It's not something we dip into all the time. So a common goal amount, and I don't want to scare anybody with like these talk of 6 to 12 months of expenses. It sounds like so much money, and this is a long-term project to save up to. This is not something you're going to save in the next 6 months. But I think getting in your head what is a comfortable amount, and I think if I had been talking to you a year ago, you might be listening to me in a different way. We've all seen, whether it's been you or somebody that you know, we have all seen people that either needed to use an emergency fund over the last 6 months or maybe or wished they had an emergency fund, really got themselves into trouble because they didn't have cash. So hopefully people are taking it a little bit more seriously now that almost anybody can be affected. And you do need you need money available to keep your family fed and housed and things like that. So the common goal amount, there's different people will say different things. It really depends on your personal situation as far as things like how stable your job is. Do you have a spouse also bringing in money? If it was a couple and they both had very stable, let's say they're teachers and they, very safe jobs, probably 6 months would be more than enough. But if let's say you are the only income you're getting is from your small business, I would say probably closer to 12 months as an ultimate goal would be more comfortable. And then, of course, it says critical expenses, which means that it's not necessarily what you are spending now. Obviously, if you lose your job, you should probably not be going out to eat, twice a week. And then it needs to be, this is one thing that comes up a lot, is people want to invest their emergency funds because they're kind of like, hey, I have all this money sitting here and I want it to work for me. But that's not the job of this money. The job of this money is to be safe and to be available for you if you need it. Because as you can imagine, I mean, obviously not always, there can be you can be disabled or your spouse can pass away at any time. But if it's like recession related or your spouse loses a salaried position, in all likelihood, that is probably going to happen during a recession when the stock market has gone down. So you are accessing your money. You need to access your money at a time. It's a terrible time to take it out. It's just too risky. So you can't invest your emergency fund. So what I usually recommend is if you have a chunk of cash, you can put it in a CD. If you're adding to, if it's something that you're adding to every month, then usually like a high interest checking account. A high interest savings account. But I will say when I say high interest, that is really in air quotes right now because the highest interest savings account you're going to find is about, if you can find 0.75%, you are very lucky. That right now they're super, super low. But again, that's not the job. Just eke out as much interest as you can. And then the savings cushion is kind of, I don't know if I was going to say it's kind of the opposite, but I guess that's not. Its purpose is just a totally different purpose. Like this money is available for you to use. So it's supposed to be available to absorb those large, unpredictable expenses that usually fall, I find, in one of 5 categories. Car expenses, like car repairs, minor home repairs, something like I need a new appliance, not like I'm renovating my bathroom or I need a new roof, but minor home repairs, medical expenses, vet expenses, and then I have recently added on kid expenses. So, your kid going to summer camp, like, that's going to happen. It's large and it's probably, you're not going to just most likely absorb that in your monthly expenses because some camp is really expensive. But, or let's say your kid is starting lacrosse and all of a sudden you need to buy $200 worth of equipment, things like that. That's what this is there for. And so you should be willing to use it if appropriate, because I definitely have had people who have credit card debt and have enough savings to pay it off and they won't do it. It's like a psychological thing, but they're paying, 20 or 25% interest on this credit card. So financially, it just doesn't make any sense. And then people like benchmarks, it's obviously up to you what you save for any of these things, what is comfortable for you. But what people like to know, what should I be aiming for? And I think around $2,000 to $3,000 if you are paying off credit card debt, and then maybe in the $5,000 to $15,000 range if you're not. And again, this is not something that you're going to do overnight. Like, don't freak out because that sounds like a crazy number. But just make that a goal. That at some point, you're going to maybe if you've got $1,500 now, that in the next two years you'll get it up to $5,000. And then for your business, you also need, and we kind of already talked about this, you also need cash for your business, as I'm sure any of you who actually have a small business right now have seen. So I put 3 to 6 months. I think it depends. You really have to look at your business finances. And how many expenses would you have if you, let's say, we're not in business, as most of us were kind of closed down for at least a couple of months. So just giving that some thought, maybe somewhere in the 3 to 6 month range would be comfortable. And then also, of course, this needs to be in cash. When I say in cash, sometimes people think I literally mean cash, like in a safe in their house, and I don't. I just mean cash in the bank, like liquid that you can easily access. Okay, so I'm going to go back. And the rest of these I'll go through a little bit more quickly here. So the next step, once you have no more credit card debt, if you ever did, then think about increasing your retirement. And again, I have 10 to 15% on here, and it's not designed to scare you if you are not saving anything. And also the one thing I want to add about retirement, especially for self-employed people, is a lot of them don't save for retirement. We are going to talk about that. But you may say, well, I have other plans. Like I have been collecting rental properties, and so I'm going to have plenty of income from that. So and when I'm talking about saving for retirement, I'm really talking about those people who Social Security is going to be the only source of income. So saving in order to supplement that. If you have other plans, you've like created passive income for yourself, that's a different scenario. But in this presentation, I'm talking about people who don't have that and should be saving for retirement. So again, the 10 to 15%, like that's a nice ultimate goal. If you are at 0 or 2% right now, just seek to increase that a little bit. So if you are not saving anything and you feel like that this is something that I need to take care of, maybe start by putting $50 a month into a Roth IRA. We're going to talk about ways to save. And then in 6 months, make it $75 a month. If you have a job where you have an employer plan, usually what I say is, like if you're at 3% right now, next time you get a raise, make it 4% because you're not even going to notice it. So do like little incremental baby steps, and it will really make if you're spending the next 5 years increasing that, it's going to make a huge difference down the road. And then this is where you start your emergency fund if you are not currently paying off high interest debt. And so these things, you're probably like, we haven't gotten anything fun yet. This is all terrible savings. That seems overwhelming to me. But this gives you a really strong financial base. It gives you a safety net, and it gives you a lot of security so that once you kind of have this stuff started, once you're building it, you then have money to take care of the other things in your life. And if you are in the position where you just you're not a person that keeps savings, I got to tell you, it feels really good to have money in the bank and bills come in and you're not worried about when is my client going to pay me or like when is the next job coming in. You know that you can take care of it. It gives you, I think sometimes you don't even realize how worried you are about it until you finally don't have to worry about it anymore. So then number 5 is other debts, which is kind of mid-range interest, although I think 15% is still really high. So usually it's student loans. What I see most commonly is student loans. Sometimes people have personal loans, which are like 10 or 12%. And then sometimes there can be very low interest credit cards in the 10 to 12% range as well. And one tool that I use in almost every meeting that I have, unless the person has no debt at all, is it's a tool from bankrate.com, and it's called Credit Card Payoff Calculator, but you can use it for any debt, except if the debt is over $100,000, it just doesn't work. But you put in the balance of the debt, the interest rate, and what you are paying now. Usually that's what I start with, because a lot of times when people come to me, they don't necessarily know when the debt's going to end. Like their student loans, they just don't know. And so then we kind of say, okay, as you're paying now, then it calculates, okay, in X number of months, in like 79 months, this is going to be paid off. And then if you're in the position where you're like, okay, my retirement started, but I got to get rid of these student loans because they're killing me and it's making me nuts every month to pay these off. You can say, okay, well, what if I did $100 less to my retirement and $100 more to my student loan? And then just put that in, and it just immediately spits out what the new payoff period is, and it makes it really easy to visualize and to make those decisions because you actually have real numbers. So it might say, okay, it's taking my student loan from 9 years to pay off to 6.5. And so is it worth it to put that X number of dollars toward it every month? So continuing the emergency fund and then other savings goals. So on here, the first one I have is college, because we cannot jeopardize our own financial security in order to pay for college for our kids. I have 4 kids. A lot of you guys know that. And college, I mean, in Maine, the good thing is with 529 plans, there is a little bit of free money. You can get up to $300 free per kid in the 529 plan if you put money in. But you can't sacrifice your whole financial security or your retirement in order to put your kids through college. And this is where the other fun stuff is, like travel, or if you want to buy a camp, or you want to, renovate your house. This is where that stuff comes in. And I will just say, saving as much as you can toward a goal is so much more preferable than, like, let's say a vacation. Because I've done this both ways. Gone on vacation, not paid for it ahead of time, knowing that I'm going to have credit card debt when I get back, or, I'm going to put on a credit card debt and it's going to drain my savings account. That doesn't feel that good. Saving for a vacation ahead of time and knowing that the only thing you're paying for when you get home is a few incidentals, that feels really, really good. And so I get a lot of clients in, older, and their finances are in pretty good shape, and travel is a priority for them. So we'll talk about, okay, what does that mean dollar-wise? And so it might mean, okay, every 2 years, I'm going to take an expensive trip, so $6,000. And so then all that means is they start saving $250 a month toward it, hopefully into a separate account. And so then they build it up, and then they spend it and they build it up. But it makes it really smooth again, in terms of you're not paying, $4,000 in 2 months for that you have to come up with. You've been saving for it all along. And it just makes your life a lot easier and a lot less stressful, because you know what to expect. And then the last thing, and I feel like I don't know, Tommy, you'll have to let me know if there's questions. We can stop at the end of the slide if there are. Low interest debt. So that's usually your mortgage and your car loan. And when I say low interest, I mean like under 5%, usually 3 or 4%. So people love to pay down their mortgages. And it's really kind of one of the last things. If you have all your ducks in a row, absolutely go nuts, pay down your mortgage. If you're maxing out retirement and you've got more money than you know what to do with, an auto loan is a little different. I have paid down 0% auto loans quicker because I just don't like having them. And at least when you pay down a car loan, it frees up your cash flow. All of a sudden you don't have that, let's say $300 car payment. Your mortgage, the problem is you're taking liquid cash and putting it in an illiquid asset, which means that it's hard to get money out. So if I, let's say, were to inherit $50,000 and I put it down toward my mortgage and I still owe, let's say, I don't know, $200,000, I'm still going to be paying on that for another 12 or 15 years. Like, that's not helping me at all. And all it's done is gotten rid of my $50,000. It's cutting the mortgage shorter at the end of it, but that's a long time to wait. And if I need that money, let's say in a year, I decide I really wish I had that money back. The only ways to get that money back are to sell my house or to take out a loan. But then I still have to pay it back. So other than those people, like I said, who are just have more, having a guaranteed 3% paying down your mortgage is not the worst investment you could make. But there's something else you can do that will be more beneficial for you in the long run. And then the other people, though, that I agree it does make sense are people who come to me and say, I want to retire in, let's say, 6 years or 8 years, and they want their mortgage to be paid off at the time of retirement, which to me makes sense, because that way they are freeing up that cash flow at a time that their income is going to go down. And so it just makes their lives easier. But other than that, like, paying down your mortgage is really pretty far down the list. And hopefully at that point, and you certainly shouldn't do it if you don't have a full emergency fund. Okay, I'm ready to move on. Tommy, is there any questions?
Yeah, Allison, there were a couple of questions that came up just from the last topic you went over. First, someone asked if you could repeat the URL for the debt calculator.
Oh yeah, I'm sorry. I should put that on here. So it's called it's bankrate.com is the name of the website, and it's just called Credit Card Payoff Calculator. And I literally just start typing that in and it pops up for me. So they have two credit card calculators, and the one you want is credit card payoff calculator. The other one does something a little bit different. So I'm sorry, I don't have the actual URL. Because I usually just start to Google, and I found it by Googling the first time.
We will put it in the
Yeah, I
event
can
wrap-up.
find it. If I can send you the link, Tommy, and you can put it in the email.
Perfect. And then we had one other question that came through that seemed rather pertinent to what you're talking about. The question was, if my student loans under $6,000 are in forbearance, is that accruing extra interest? And should I take money out of my savings cushion to pay this?
That's a really good question because, yeah, I mean, anyone who's federal student loans right now are not paying any interest on that. And so it's a great opportunity. And it's a really good question because it kind of depends, of course. This is personal finance, it's very personal. So I think the answer is if you are draining your savings cushion to do that, don't do it. And actually, when I've had clients in the last few months, what I have actually encouraged them to do is if they have something else, because they're paying 0% interest right now on their student loan, if they have something else that maybe would normally be a little bit lower priority, they can make progress toward it. Like, for example, I think some people I'm thinking of were trying to save for a house. And so, while normally if they didn't have that kind of extra goal, I would have said, no, keep paying your student loan. But because it seemed like a good opportunity for them to put cash to the side and build up a little bit more savings. I know that's not what this question is. This question is, should I take money out of savings and pay it off? I mean, a lot of people don't like to get rid of their student loans, which is understandable because they make them crazy. It's frustrating to have to pay them. So I think I have nothing against paying off lower interest loans earlier, especially if it's like this situation we're talking about where you would be paying it off. But even if you're not paying it off, I'm not answering the question. It kind of depends on everything else that you have going on. I think that as a quick answer, what I would say is if paying it off would leave you with a comfortable amount still of savings, then I probably would do it because I probably would want to get rid of my student loan. Strictly financially speaking, it makes sense to actually not pay toward your student loan. But in reality, how much interest are you earning on your savings account? So that's the answer I would give.
Thank you, Allison. And that question was from Maureen, and I suspect she may follow up with you afterwards. Before you start the next slide, I want to let everyone know that Kimball put in the chat for everyone to see the URL for the bankrate.com calculator. So go ahead and take a look there.
Thank you.
If you guys want to cut and paste that.
Yeah, but, we can also include it on the email as well. So, but that's great. Thank you for doing that. Okay, so I can move on. Okay, so we already did that. And then this, I'm not going to spend really any time on this. This is just a summary of kind of everything I just said. I would say the only point on here that I always forget to make is the first bullet that says focus first on paying down the debt as well as making sure it won't happen again. That really refers to credit card debt. And so just if that is something that you've been struggling with, understanding why you have credit card debt. And of course, in these days, it certainly could be because there was a pandemic and you couldn't operate your business for 4 months. But understanding why and taking steps to make sure it's not going to happen again. Because if you are consistently incurring credit card debt, anything you do right now to pay it off is just going to be a Band-Aid. And any savings you make is ultimately going to just go to pay down future credit card debt. So just, I get people in with sometimes significant credit card debt. And sometimes it's like, well, it was a period of unemployment or we had medical expenses or there's something, but we've been living on cash for the last 5 years. And in that case, I'm comfortable that they are no longer going to incur more credit card debt, but just understanding the source of it. And this has nothing to do with, I get a lot of emotions in my office, so a lot of guilt and shame about things like that. And this is not about that. This is just about understanding what happened so that way we can avoid making the same mistakes in the future. Everything else I think we already talked about, so I'm not going to go through them. Okay, so investing. And when I say that, I'm referring mostly to retirement plans, because that's really what's different between being a salaried employee and a self-employed person. So if you're self-employed, you have more choices. But like I said before, like a lot of self-employed people I see don't really have anything saved for retirement, because I think it's because in those first few years that we're in business, many of us don't make any money. We're spending the time building our business, and so we don't start putting money to the side for retirement. And then by the time you are profitable, you've got that money going other places. And so or you always think, oh, I'm going to do that later. And also, when you have a salaried job and you have access to an employer retirement plan, as you know, if you've ever had that, they make it really easy. You just like fill out a couple forms, sign the bottom, and you're in the 401k. But when we're self-employed, we have to do this ourselves. And so the first bullet on here, traditional or Roth IRA, it's available to everyone. This is not specifically self-employed people, but it's often a good place to start because it is the easiest in terms of like red tape and paperwork. It's the easiest thing that you can do. So I'm not going to go too deeply into it, but a traditional IRA is you get the tax deduction for putting money into it. At the time, like the year that you contribute, you get a tax deduction. And then that money grows tax deferred. And then in retirement, you take that money out, and let's say you take out $10,000, you get taxed on $10,000 on the whole amount. So money you put in and money that grew, the earnings on it. And a Roth IRA is the opposite in that you put after-tax money in, like it just comes out of your checking account or whatever. You've already paid tax on that money, and you put it in a Roth IRA, and then it grows tax-free. And then when you go to take it out in retirement, there's no tax effect as long as you're old enough and you've had the account for 5 years. There's a couple of little requirements, but that money is tax-free. I will say that all the accountants I know use Roth assets, either a Roth IRA or some of them at work have Roth 401ks. So do what the accountants do because they usually have run the numbers. I use a Roth IRA myself. So the contribution limit is $6,000 a year. If you are age 50, you get $1,000 a year additional that you can put in. And so it's a really, really good way to start because for many self-employed people, they're not quite ready to put in more than $6,000 a year. The only caveat is if you're putting money in a Roth, there is actually an income limit. So, and I have it right here. So it phases out. There's like a threshold. There's a band of income that it phases out. But if you're single, you can't put any more money in it once you make $139,000 of taxable income. And if you're married filing jointly, it's $206,000. So just keep that in mind. There is actually something called a backdoor Roth. So if you were in that category and you'd still like to contribute, there's something called a backdoor Roth. You can Google it. It's totally legit. It's like a loophole that is acceptable, legal. It's nothing super tricky. But once you graduate, let's say you get to the point where you're like, 6,000 is enough. I really need to do more. There are some plans that are just for self-employed people. So a SEP IRA is, I would say what I have seen, I prepared taxes for about 14 years. And the SEP IRA is the one that I would see the most. I think because, well, it's older. The solo 401k has the same limit. As you can see, the contribution limit is really, really high. You can put tons of money into a SEP. So what I would see is like doctors who have salaries and then consult on the side. They would take like you can put in up to 25% of your Schedule C income, and they would just put in the max to get a huge tax deduction. So if you are in the position of you want to put in $30 or $40 or $50,000 into retirement and you can do that, you might want the tax deduction. And the SEP, I think, is the simplest in terms of just setting it up. And you can actually do that and have employees and do it for your employees. SEP stands for Simplified Employee Pension Plan. And you can have actually any number of employees. And the solo 401k is much newer. And that's just for you as the self-employed business owner or you and a spouse. You can't have other employees in a solo 401k. But what I like about it is it can be a Roth. Depending on if you open it up, depending on where you open it up, you might have the Roth option. I was actually looking into it for myself, and I was looking into Vanguard, and you can open a Roth solo 401k. And then the other one that's common, although I personally haven't seen it a lot, is the simple IRA. The contribution limit is much smaller, as you can see. It's called Savings Incentive Match for Employees. And I think it literally is designed to be simple. Like the name isn't just an acronym. It was designed to be like a simple plan for small employers. And it's for 100 or fewer employees, sorry. But I put on here a link to an article because I can't go into all the details. We don't have time. And this NerdWallet article was really good in terms of this, this is who qualifies for this. This is the amount of paperwork it is. This is the reporting requirements to the IRS. So if you are at a point where you're like, I need to level up in terms of my retirement savings, you can look into one of these. And then HSA, so that's health savings account. And for those of you who are eligible, it's because you have a high deductible health insurance plan. And I mean, it's great anyway, because you put money in tax-free and then you pay your medical expenses right out of it. But it's also an opportunity to save and invest for the future. So what I will see tax professionals advising their wealthy clients is max out your HSA and then don't use it. You pay for your medical expenses out of pocket. And then that money, depending on where who's holding the HSA, like if it's at a bank or a different institution, you can often invest that money over, like they might say you need to keep $2,000 in cash, but anything over that you can invest. And so you can see based on the limits, like if it's not just single coverage, you can put $7,100 in it every year. And this actually is triple tax benefits because you put the money in, it's a tax deduction, it grows tax-free, and then when you take it out, it's tax-free. So it's better even than a Roth. When you take it out for medical expenses, it's tax-free. If you take it out for something else, it's not. So that's actually a way, if you do have kind of extra money and you're looking for a place to put it, it's a really smart way to save money, because in retirement, we are likely going to need a lot of medical, we're going to have medical expenses, and you can use it to pay Medicare premiums. You can use it really for almost anything. It's super flexible. And then the last thing on here, taxable brokerage account, that word's kind of, a lot of times people look at that and they're like, I don't understand what that means. When it says taxable, it just means it's not a tax advantage retirement account. So it's like if I open an account at Fidelity and I buy stocks and bonds, that's a taxable brokerage account. Taxable just means you're paying taxes as you go. It's not tax deferred for, 25 years until you hit retirement. So if you have an account and you buy like mutual funds or ETFs or stocks or bonds or something, and those investments generate income, so they usually dividends or interest every year, you just pay taxes on that as you go. So every year, you depending on how much you have, maybe you pay tax on, a couple $1,000s of dividends or interest. And then that money is available for you at any time. So especially kind of the younger you are, if you're like, well, I don't really want to tie up all my money for the next 30 years, you can have the taxable brokerage account gives you a lot of flexibility because you might want to use it before all those other accounts you can't access till you're 59 and a half unless you want a penalty. So having a taxable brokerage account is just a way to save for the long term, and you're not tying up your money in any way. Okay, so Tommy, you'll stop me if and then if there's questions. Okay, so we're going to talk real briefly about compound interest. And so the point of this is, if you are young, to inspire you, hopefully, to help you understand why saving early is important. And compound interest just means interest earned on other interest. So, for example, if I had a savings account that by some miracle I was getting paid 10% interest on, I put $1,000 in, at the end of the year I have $1,100, and then the next year I'm earning interest on $1,100. So it sounds like it would be nothing. Like it sounds insignificant, the amount of money. But this chart shows, so this is for somebody who is saving $100 a month. I tried to make it like relatively modest, and they're earning 6%. So just, if this money is not in the stock market, well, it's also not in a savings account. if it was in the stock market, usually what you would use, the stock market historically has returned after inflation around 8%, like since the inception of the stock market. And of course, as you know, it can go 30% in one year, -10, it can be anything. It's usually not 8%, but that's kind of what it averages out to be. And the words compounded monthly here, that just means you're calculating the interest every month. And so I just did this example for 40 years. So the red line is the amount of money the person is putting in, which is why it is a straight line. So by the end of 40 years, they have put in $48,000. And the blue line is the balance in their account because they're earning 6% a year. So you can see for the first 5 or 10 years, the compounding is like not that significant. And of course, if this was, compounded at 10%, it would go more like, whoops, whoa, I didn't mean to go there. It would be much steeper curve. But over time, those people who have been investing and they've been in the stock, investing for 25 or 30 years, the amount of money in their account that they put in is very small relative to the balance in the account. So if you are young and considering investing, time is on your side. That's the best thing that's the biggest asset that you have. And so then I just have one more chart, which shows 3 different people. And the first person, each of them saves the same amount of money. So each of them saves $3,000 a year for 10 years, but they save it at different points in their lives. So the first person saves when they're 25 to 35, and then they don't ever save anything else. They just let that money grow. And then when they're 65, they have $247,000. And they've only put in $30,000. And the next person, again, is investing that $30,000 from 35 to 45, and they end up with $136,000 at age 65. And then these folks starting at 45, they end up with $74,000. So I'm not saying this, especially if you're kind of in that 45, 50, 55, to think, oh, it's too late, I can't do anything. Like, you might be at the point in which you are making, you're in your prime earning years, maybe your kids are gone, perhaps your mortgage is being paid off. So you might be in a position that you can catch up if you're focused on it. The point is, and I bet for those, if you are one of those people, I bet you wish you had started sooner. So this is just to emphasize that the earlier you start, just the easier it is. You don't have to put very much money in order to make a lot over your working career. Okay, so taxes for self-employed people, of course, are all more complicated because if you're a salaried employee, you just have a W-2 and that's it, usually. So maintaining good records, I kind of talked about this at the very beginning, but again, you don't have to have software. Like I prepared tax returns for many years, and don't walk in with a box of receipts, because you are either going to pay someone $150 an hour for them to go through your box of receipts, or they're just going to estimate based on what you did last year. So it does not need to be fancy. Like, I've definitely gotten a yellow piece of paper ripped off a legal pad. And as long as it has numbers on there, that's the numbers I would enter. Your tax preparer is not auditing what you're doing. They don't need a receipt for every single thing. What they should be questioning is if you have something that's unusual, or kind of unexpected for your kind of industry. You are going to want, of course, good records if you have mileage for work. And I know they have apps for that. I only travel for work like 3 times a year. So I just keep it. I think I keep it in an Excel spreadsheet. But just kind of clear, easy records, and keeping those separate business and personal accounts makes it that much easier. Because there are people who are like, don't do anything the whole year. But if you can go back to your 12 months of business bank statements, it's probably not that much, depending on how complicated your business is, it might not be that much activity. And then this used to say keep up with estimated payments, and now it says make sure you have enough at tax time, because you want to make sure that you have enough money to pay the IRS. And again, this is one of the things that's also similar to why people aren't saving for retirement is because your first few years in business, you may not have made any money, or you may in fact have lost money, and it might have been good for your tax return to show your business. And so it takes a while. So for those first few years, you don't need to put money aside for taxes. And then all of a sudden you're profitable, and you do, but you're not used to it. So that can be a tough adjustment to make. But I will say, of all the kinds of debt that I help people with, tax debt is the hardest. Even though it's not a very high interest rate, it's like 5 or 6%. The problem is it is always a moving target. Like, you can come to me with credit card debt of 25%, $30,000 of credit card debt, and we can get you off that. Depending, if you make enough money, we can set it up so that you're debt free in 4 or 5 years. Tax debt is really difficult because in order to pay off your tax debt, you need to make more money. So you are incurring new tax debt. It's just a very difficult wheel to get off of. And it is always a moving target. So I really strongly advise people to make sure that they do not get into that situation where they owe the IRS. So one way you can do it is, if it makes it easier for you, is paying estimated tax payments. You're supposed to do that if you're profitable. I don't even really care so much if you pay estimated payments. Like, the penalty if you don't of course depends on how much money that you owe. But usually the penalties I see are like under $20. It's not really even that significant, but I don't want to waste $20 on a penalty. But if the hassle of estimated payments is like too much for you, you can just say, I'm not going to do it. But make sure you have that money available in March or April, whenever you're paying your taxes. And then along the same lines, consider a separate bank account. So if you are in the situation where you're profitable, consider every check that comes in, putting aside some portion of that. One way to figure it out, because it can be complicated, because if we can have a spouse who's working, or we might have the child tax credit if we've got kids, or other different sources of income. So I would say the most that you would ever need to take out would be like 30%, which might sound crazy high. If your business expenses are high, then you wouldn't need to take out anywhere near that. What you could do is look at last year's tax return and see how much you had to pay because of your business. What wasn't withheld from, let's say, your spouse's W-2, and then divide that by the income of your business. And if it's 15%, then put aside 15% into a separate bank account. If you think that's you need that kind of discipline, because otherwise you just don't want big surprises come next April. It's very unpleasant. And then if you save too much, you know what? That's great. You can pull back, and then you'll have extra money in that account for next time. And then forming a relationship with a tax professional is, if you are going to want any kind of tax planning, it is really a good idea to get a really good tax professional who is not just it's not just data entry, putting in your stuff, and then, saying thank you very much. They can really help you in tax planning. So they're the person you would go to if you're like, hey, should I do a SEP IRA or simple? They often have really good, they know, and they can give you tips on how to reduce your taxable income or things. It can be really worth it. Your business might be simple enough now to use TurboTax, and you can do that. But if you are getting to a place where you feel like tax planning would be useful, then finding a good tax professional is a really good idea. And then there's only one other slide on here, and I'm not going to go through all of these. These are just kind of like, think about kinds of insurance that you might want. It's business, but it's also personal, because especially if you are if one of your major sources of income is from your small business, you need to protect your personal finances through business insurance, or vice versa. You need to protect your business by getting personal insurance. So this is just a list of insurances that you might want. Like, I have general liability and professional liability. My business doesn't really own anything, so I don't have property. Life insurance, if your family or if somebody relies on your income, whether it's a spouse or your children or your elderly parents, if someone's relying on you, protect your life with insurance. And then same thing with disability, because you're just way more likely to become disabled than you are to pass away. Personal umbrella is protecting your personal assets at a higher level. So, and I'm actually, if you're like a renter, if you don't own a lot of assets, I don't think personal umbrella is necessary, but I would talk to somebody about it. It's usually you buy it in increments of $1 million, and you have to have a minimum amount of auto insurance and homeowners insurance. And I have it $1 million. It's like $100, $130 a year. And then there's other things like business interruption insurance might make sense. And then if you have workers, workers comp, if you use your car for work, make sure it's covered by your auto insurance. And then of course, if you make products, one thing I thought about was additional homeowners insurance. I don't know whether working out of my home affects my homeowners insurance, so I need to check that out, and then key person insurance. So these are just all things for you to consider whether or not they make sense, and talk to your insurance professional. So that is everything. So this is my contact information. I just had a panic attack, but nobody could see me. I'm going to stop sharing. Are there other questions in the chat?
Yeah, Allison, that was great. We have
sorry.
Can you hear me okay?
Yes, it was so quiet that I really worried that like I had gone out and was just talking and nobody was hearing me.
No, we've got 30 people who are waiting on your words. No, that was
okay.
great. We have one question that I did want to get to you before we wrap up. It says, as a consultant, companies would rather hire me as an individual rather than a company. How do I handle the income so that it doesn't appear as commingled money?
Oh, wow. That's a really good question. So I'm curious as to why. Why does it matter to the company if they're hiring you or your company? Or
may I chime in? That was my question.
Yes,
so
I'm curious.
I'm a former educator, and so a lot of the people that I'm dealing with are educators who are either paying out of pocket or they're paying from a school budget, and school contracts sometimes are very messy, so they just as soon pay me straight.
Oh, okay. That's something I've never heard of before, so I'm glad you shared that. You know what? I think I do have the answer for this, which is because I think you can take a check if you are the owner of the business. And I am only saying this because I've done it for my business is my name. So it's not an issue if somebody pays me a check in my name because I can deposit it either way. If you have a business bank account, I think if your name is on the business account as the owner of the business, you can deposit a check made out to you into your business account. Does that answer the question?
It does. I was just wondering for liability and making sure that you made a comment at the beginning about you don't want to commingling because of liability.
That's a good question. And I think you've exceeded my level of expertise. I don't know. So you are incorporated or you, because if you're not
I'm an LLC.
Okay. That's a good question, and I actually don't know the answer. I think you're getting a little, you're like crossing the line into legal territory.
No problem.
I don't know if somebody helped you. Yeah, if somebody helped you get your LLC, like if you got it with an attorney, I would call them and find out.
Perfect. Thanks.
Allison, that's a perfect opportunity for us to segue. And if you have further questions, Allison will provide her contact information on the email that we send out later today. But thank you again for a great presentation and for everyone who attended. A quick reminder that today's presentation will be recorded and that the link to the YouTube channel along with the slide deck will be available in that email. To stay up to date on any chamber events, visit our website and click on events. We do have a special Kegs and Issues coming up this week on Thursday the 22nd at 4 p.m. It's going to be with the Boston Celtics leadership team discussing racial and social injustice, and registration is still available. And thank you all for joining us today. We hope you had enjoyed the presentation. If you have any further questions about the chamber, please reach out to us and we can tell you more. And have a great day. Bye, everyone.
Bye. Thank you.